Traders enter fair value gaps randomly from the beginning or 50%, but what if you could predict exactly where price will go? That's how I always get much higher reward to risk trades, and today I'm revealing my method. This approach transforms low reward to risk trades with wide stop losses into precise and sniper entries with tighter stop loss and much higher reward to risk. This is something that no one ever explained before, and I've been using this for the past 2 years, and I decided to teach it for free today. Some of the questions that I'll answer in this video are: how do you get sniper entries using fair value gaps and liquidity? How can you predict how much of a fair value gap would be filled? How do you blend fair value gaps with other PD arrays? What is fair value gap internal analysis? And much more questions. Make sure to watch the video till the end, as I'll also share a complete trading plan based on today's concept that you can follow easily and start getting high reward to risk trades just like me and my students. Let's begin. So that is what we're going to be discussing today. Let's imagine that this is a fair value gap, which is a 3-candle pattern where the low of this candle does not overlap with the high of this candle. All right, so that is the fair value gap, but I'm putting it here, imagining that this is the wick here and this is the wick. So that is the fair value gap. What a lot of people, and most people actually, they're going to look at this fair value gap, maybe take a quarters or measurement tool here with the quarters and focus on 50%, focus on a 25% retracement, 75, and sometime fully. How I see a lot of people doing it also is just entering at the beginning of the fair value gap and then either cover the high of the fair value gap or cover the swing high that caused this fair value gap. Now with this method, just entering randomly from here, you're basically sacrificing a lot of reward that you could take 50% or from here, but this is not enough also, because sometimes you could enter from 50% where price can go here. Now how you could predict this, and instead of just entering from the beginning or 50% and then sometime price will hit your stop loss, if you put it slightly above, then this method here will allow you to know where exactly price can go into the fair value gap. So you see this 50%, but I've done this a lot and people ask me, oh Mulham, how you do it? This is the answer. I predicted that this fair value gap would be filled until here. Now I do not get it right all the time, and you will not be able to do that because there is nothing that has a 100% win rate. However, you could get it a lot, take more rewards than before when doing it the traditional way. All right, so I'll teach you how to know exactly where price will go into a fair value gap. So the question will answer, for example, we have this fair value gap. So the question will go with, why did price retrace all the way to here and all the way to here? And why did price react from here first, then from here second, and then here, and then here? So these are the questions that I'll answer in this video. First of all, we need to understand, what are we going to rely on this method? We're going to be relying on internal analysis. And this is something that I taught before, but I believe not a lot of people paid attention to it. And I called something like this, where we have normal fair value gap, and then I called it MFVG. That's just my naming for it. That is the MFVG here, which is the one that you're going to get the sniper entry from. That is what I taught. And today's video, we're going to take another approach and different scenarios that we can rely on. So now if we look at this fair value gap, also this one, why did price retrace only to here and not here? Same thing, why only here? And that is going to answer a lot of questions. Also this one, why did price go all the way to here and not just stop here or 50%? Let's imagine this as a fair value gap that is bearish, right? Now this is for our fair value gap that we can see just like this, following a time frame alignment of 4 hour to 15 minute. You could also go to the 1 hour, 30 minute, and the 5 minute, including the 50 minute also. The more you go lower, the more details you can see, and the more noise also you can see. So inside of this fair value gap, what we can see where it was created, you could see something like this, right? Now this is where the fair value gap was created. You could see something like this. In the 4 hour, you see nothing. On the 15 minute, you see this. This is where the creation of the fair value gap was happening on the 15 minute. And this is what we're going to be taking advantage of. This is what we're going to be focusing on. So this is a 4-hour fair value gap. What a lot of people would do, and this allows you, following this method, on fair value gap. So you could take small scalps based on reactions of levels, not always just spotting the highest one, but you could spot any reaction of the fair value gap. So this is a 4-hour fair value gap. Now the time frame alignment that we're going to be following for the 4-hour is 15 minutes. That is the main time frame. However, you could also look at the 1 hour, the 5 minute, and then the 30 minute. Okay, so you could take a look at those, but the main one is going to be the 4-hour. For the daily, the 1 hour. Also for the 15 minute, it's going to be the 1 minute. All right, and I always talk about those time frame alignments. So looking at this fair value gap here on the 4-hour, before looking at the fair value gap, we want to agree on something, that this step that I'm explaining in this video is going to be the last step that you look for in a fair value gap. Before everything, you should look for all of the confluences, all of the things that makes a fair value gap a high probability. And I cannot cover everything in this video. That's why in the description, I'll leave different videos just talking about how to find the highest probability fair value gaps. And I watch all the videos and then do this at the end, and you have a perfect trading plan. So looking at this 4-hour fair value gap, we're going to first take a look at the 1 hour. This is what's happening on the 1 hour time frame. All right. Now there are a few things that we need to focus on, and I'm going to put them in this order. First of all, we want to focus on inducements, all right, which are liquidity levels. And mostly on this situation, we want to focus on liquidity levels that has POIs above. In this case, because we are in a bear scenario, we want to focus on highs that has POIs above. All right, that's the first thing. Second is order blocks. And then third, we want to look for overlapping. These are the three things that we want to focus on. All right, now on the 1 hour time frame, you can see that we have this big fair value gap here. This is all rebalanced. So mostly, now this is the first step. Mostly, we can see that there's no real fair value gap here. Here is the fair value gap. All of this is already rebalanced. Now, we want to focus on this zone more. That does not mean that we will not have reactions from here, but this is where the real reaction is going to be at. All right, so that is the first step. Now, looking at the 15 minute, actually, I'm going to make another rectangle here and then go to the 15 minute. And we want to think all together. What do you see here? What do you think is happening here on the 15 minute time frame? The first thing that I can see is that this is the 1 hour fair value gap inside of the 4 hour fair value gap. This is all rebalanced, and this is the real fair value gap. So the reaction would be from somewhere in here. The least that you can do is, instead of entering here or entering from the 50%, you could have your limit here. That's the easiest thing. Okay, and now we can refine it more, but that's the easiest thing, which is entry here instead of here. So let's say that we find an entry here and then targeting the lowest low here, the body of the lowest low. Taking this entry is a 4-to-1. If we take the beginning of the fair value gap, that is 2-to-1. So that's, you're losing basically half the reward that you can actually achieve easily by just following one step. So that is the first thing. We have what? Another fair value gap that is not filled, that is fully not filled and not rebalanced. On the 15 minute, what do we have? And that is the main time frame. Basically, we have this inducement here. Inducement high that has a fair value gap above. That is the first thing. What do we also have? We can see that we have this high and this high. So equal highs or relative equal highs that are almost at the beginning of the fair value gap. So marking that one, as I said, we're looking for what? Liquidity and also inducements. And then looking at order blocks. I do not see any order block here. If there was an order block here, one single bullish candle followed by, consecutive bearish candles, we could look for that one. What do you also see here? What I can see is that we have this one, actually, this overlapping is very close to the inducement. So I'll take the inducement. And do we have any other overlapping? Actually, this one, but it's out of the fair value gap. It's not part of the fair value gap. Now, 5 minute time frame, we have also this inducement. So I could, 5 minute is less significant. This is the 5 minute here. I could focus on this also, but not really, not as much as the 15 minute. Now back to the 1 hour, because I saw something, I guess, which is this overlapping. We have this overlapping, and that is another level, because we said we also focus on overlapping. This is an overlapping that we can trust. And when you have multiple entries or multiple areas or lines or POI, whatever you call it, you either can scalp all these levels. That's the first thing. Another thing is you could focus only on the extreme 2. What does that mean? We have 1, 2. This is actually not, I'm going to put it just like this because it's not the highest probability. It's on the hourly and 15-minute. So these are all higher probability. But this one, I'm just putting it here in case if I see a confirmation from there. So we have 1, 2, 3, 4. Where are the top 2? This one and this one. So you take those 2. Okay, that is the second one, the second method, especially if you are entering off limit orders. Now, if you want the best entry, you could take the extreme one, right? And then, stop loss slightly above the fair value gap, and then targeting whatever you want. You could take also, you could put a trade here, another one below on the second level, and then same stop. So in case price does not go here, you're entering off this one, and then, I don't know, take profit anywhere. But you see the difference? This is 4 to 1. This is 7 to 1. So 3% more if you're risking 1% that you're losing here. However, you could also scalp off those levels. So if you go back to 15-minute time frame, and we want to see how does price react to these levels. So playing the price action, and see here, and then bearish candle. So it's more reaction. And then it goes up again. Actually, it's respecting the other level that we mark on the 5-minute time frame. And then you see, pushing lower. So the 5-minute was actually a refinement of the 15-minute. And price is actually respecting both. So in this candle, it's respecting the 15-minute and the 5-minute. That is what? A huge scalping opportunity. You could look for changes to delivery and maybe enter here. Or you could look at the 5-minute here or the 1-minute, whatever you want. We are not talking about, scalping techniques here. We're talking about POIs because that's the most important thing. Even when it comes to scalping, you want a POI to trade off. That is your POI. So that's the first level. Now playing the price action, you see how price is going to go to a zone and then push lower. Go to another zone and maybe push lower. And it's going to continuing like this. So let's see the next one. We're pushing higher, coming again to the zone, given a reaction, but we already use it. However, another reaction, and price came very close to this one. However, we don't get the limit order activated here, all right? But we are creating maybe equal highs in this case, and then price continue going higher. I don't actually remember if price is going to go up there. Okay, it went to the second one. Now, if you're having a limit order, it's activated here. The second one, price goes to the second one, and that is your sniper entry. You could also scalp from this level. It could hit your stop loss. Another level here, price goes lower from, and then very nice order flow, sweeping a high, going lower, and then pushing lower, if you can see. So you get this entry. That is a sniper entry, literally no drawdown, and then pushing lower. Now I'm just gonna go to the 1-hour time frame to make it faster. You see price goes back there, and then okay, a little bit deeper. I don't know if price reacted off another level there. Nothing that I can see. Our first target, that is 5 to 1. Instead of, if you enter from here, that is going to be what? 2 to 1. You see, that's the order we're going to be looking for. The most important one for me is inducements, and then order blocks, and then overlapping. I would say overlapping and order blocks are the same for me. They're in the same level. Inducements are the most important ones. They actually give you these sniper entries. Now switching to the 4-hour time frame, you can see nothing here. Like, how can you convince someone that you're looking only to trade this area here instead of the whole area here? This is your real fair value gap. This is your MFVG. And then this one, I'm not trading. So anything below here, I'm not trading. I'm only focusing on this, I would say, upper half. It does not need to be the upper half, but this one specifically here, this zone. Why? Because this is the MFVG. This is where I'll be interested in entering. How can you refine it more? By entering here. You see, that is a sniper entry and going lower after. That is how you can predict where fair value gap is going to be filled. Now, for any valid fair value gap, you could do the same thing here. You could do, for example, for this one, and sometimes you're not going to have any clues. So you have two consecutive fair value gaps here, right? The 1 and 2. If we go back in time and see what do we have in here, first of all, starting with the 15-minute, because that is the right time frame, or actually let's look at the 1 hour first. First of all, we can see this clear inducement. So instead of entering from here, I would limit it to this one. And we can actually see that the whole fair value gap here is not filled. That is something that we need to keep an eye at. Actually, price can go all the way up there, all the way. On the 15-minute time frame, anything that we can see is, all right, we have this order block here. That is another thing. We always look at the bodies for the order blocks. That is another one. And I'm genuinely not sure what is going to happen here. Let's look at the hourly again. I'm just thinking same as you. We have this overlapping. I don't think that price is going to go all the way up here. That is the, actually, I'm going to put a line here in case price wants to go there. So these are the areas that I'm interested in. I think maybe we have a scalping opportunity from here, and then here, maybe finally price is going to go up here and then react. Let's look at the other time frames also. If we see something new, 30-minute time frame, that is a very nice order block. If you see that, we can look for at least a scalping opportunity. Overlappings are not clear. I actually have this one here also, but it aligns with the order block. In this case, the upper two, this one and this one, you could have limit orders, but they are very far away. So if you're taking this one, you don't need to put your stop loss all the way up here. Just put it here, maybe up here, and then if price disrespect this one, enter again from here with a stop slightly above. That is what we're going to be doing. Now let's see how price reacts off these levels. Actually, the first one, you don't need to have, you should not have a limit order here. Only use it as a scalping opportunity. All right. You see, it reacts to that level, but not much. And then it goes higher. Okay. You see, you might think that you missed the trade. Maybe yeah, maybe not. Price actually went to the fair value gap here. You see, yeah, this fair value gap. Actually, this overlapping here, this is where price, but I always look at the bodies. In this case, when we have a fair value gap, so this is something that we need to understand also. When we have a big fair value gap, and then there is an overlapping with a wick, I usually focus on the body, but there is no body here. There is no candle body aligning with the fair value gap. So you could take the wick. For me, honestly, I would prefer the order block. However, you could take the wick, and that is another sniper entry. However, I'll be focusing more order block. Looking at the 1 hour time frame here, sniper entry, which honestly I'm not going to be taking, and then price just start going lower. And this is where we discuss our first trade. So in this case, I don't think that I'm going to be getting a trade here. However, some people could quote it because it's at the end an overlapping inside of a fair value gap. So that is also a valid one. However, it's not going to be, but the perfect one for me would be the order block. Now this is 1 hour time frame on the euro dollar, and I'll show you how when you have this fair value gap, looking for continuation to the lower side, because we have this liquidity level here, and then we've been bearish overall. And if you're not familiar about this fair value gap, you need to watch the other videos that I'll recommend. I'll leave them in the description. This method only works when we are familiar with high probability fair value gaps. So we have this fair value gap. How did I know that price will only go there and not no more? Like not any other level. I'm expecting price to go from here and then push lower. Instead of entering from here and then a stop loss maybe above the fair value gap until here, that is a 2.6. 13. So you're missing about how much? 11% if you're risking 1%. How did we do that? Let's go back in time here and see. What do we have? What do we have happening here? So removing this, and let's start all together from the creation of the fair value gap. This is the hourly time frame. For the hourly, what other time frame we use? We go with 5-minute time frame. So that is the main time frame. However, take a look also at the 30-minute. Okay, so 30-minute, we have no potential for price to go here and here because all of this is not rebalance. Okay, Let's look at the 50-minute time frame. And all of these time frames are not necessary for you. You could immediately go to the 5-minute, and because 50-minute had nothing, 30-minute had nothing. Let's look at the 5-minute. You see how nothing is rebalanced here? We have this fair value gap now. Take a look at this. We have this fair value gap mitigated here, and then price pushing lower. Another fair value gap here, mitigated, pushing lower. Now, what do we have here? Do we have any types of inducements? Not really. We have nothing. No inducements. However, what do we have? The only thing we have also, no clear overlapping to the left. The only clear thing that we see are these two order blocks. We have this order block and mitigated also. We have this one and it's not mitigated. Okay. When you have two order blocks that are just above each other, so this one is above this one, and they are very close to each other, you gotta take the extreme one, because most of the time the one lower is going to be a liquidity. So that is liquidity, all right? And this is the order block at the body, and this is where you enter. Now this 1 hour fair value gap, this is going to be your entry here. So limit order, and then stop. I'm not really expecting price to go higher because we have this fair value gap here, which is mitigated. I'm gonna maybe put it somewhere in here. Now you can put it all the way up, no problem with that. However, it depends on your risk. I'm taking this as a risky one, as I'm thinking that this is where price is going to. Now, what does this one align with on the 15-minute time frame, for example? I can't see nothing. 30-minute time frame, what do we have? So a 30-minute time frame, it actually aligns with a hidden order block. Hidden order block here inside, because another 2 consecutive fair value gaps with a displacement. This is a hidden order block. Refinement on the 5-minute inside of this hidden order block, it's this one here. So that is another thing. Now limit order here, maybe targeting the low after. That is a perfect trade that you can take. So you see, playing this on the 5-minute time frame. I mean, if you let anyone see this on the 1 hour time frame and you tell them that you're entering from this specific line, they're gonna have no idea about what is happening and why you're entering from there. However, now you could impress anyone with this method. And believe me, no one ever will teach you about this. No one ever. So you see, entry from there, from this big fair value gap. So your entry, no drawdown at all, and then pushing lower, pushing lower, pushing lower. You see, that's how you get it. And then going lower. Now we have different fair value gaps here. Why did price reacted from here specifically? Switch to the lower time frame and see what is happening. I'm not going to be repeating all of this. Also, see inducements here. First reaction from here. Second reaction all the way from here. Because we're using the 5-minute, we got to use the 1 minute. There is no other method here. What do we have? Why did price? You see, this is the fair value gap. There is nothing here, only this order block. Look at this order block as a whole. So this order block or the refinement here. And we have 2 order blocks above each other, on top of each other, right? Which one we use? And this just proves to you that this works all the time. Not all the time, but when you have the highest probability, it's going to work. And there's nothing that is a 100% win rate. As an order block, another order block. This is going to be liquidity, which is the other order block. This is going to be the one. You see, taking this to the right. Could you ever have a better entry than this? And I promise you that this one, I've never seen it before. I just said, okay, let's apply this, and somehow it works. You see, sniper entry here, and then pushing lower. So if we enter this, same thing, and then maybe cover the fair value gap, that is how much? I mean, I'm not going to say I'm going to take all of this, but look at the potential of this one scaling in. You see, 16-1. That is a huge one. Look at some more examples that we can see here, and then from that we go to the trading plan, put it all together. And I'm just mentioning these a few more examples just to fully understand the idea to deliver today, all right, and explain today. You see how we have this fair value gap and this one breaker structure. So that is kind of a valid fair value gap. Marking this fair value gap, and I want to see where can price react from. So basically, the first thing that I can see is this overlapping, like on the 1 hour time frame by itself. So yeah, by itself, this is an area on the same time frame that we can expect price to go there. Now, can we refine them more around this area? around this wick, and you could also take the wick itself from here to here. However, this line here, I want to see a 5 minute because I'm on the 1 hour. I want to see, do we have anything on the 5 minute aligning with this overlapping? Actually, what we can see is, you see, bearish, bullish, bearish. So one bearish candle and then engulfing. That is what? An order block. This is our order block here. That's where we can enter. Now, there is another zone that price can go to, which is this inducement and this fair value gap. So these are two zones that I'll be interested in buying, playing the price action. So playing the price action, we can see that what happened is, and we have two zones here. So you could have a limit order here, and then a stop below both. Price going there, wick, not much displacement below, actually no displacement at all. And then what happened after is price pushing higher after that. See, the timing was not perfect. However, now another fair value gap that I was seeing also on the 1 hour time frame and in the same zone here, it's actually this one. And what do you see happening is price reacting once from here and then twice from here. Now I really want you to see the precision of this, how precise this method is. And again, no one ever talked about this. This is my own method. So I hope that if you use it, you can mention me on Twitter, Instagram, anywhere. So you see one zone here, one reaction here, and one reaction here. We go to the 5 minute time frame and we see, what do we have here? First of all, when the fair value gap was created, this is the first touch. Where does it come from? We have this inducement and this fair value gap above it. So we take the fair value gap because we have inducement, fair value gap above. We take the fair value gap. So you see, first scalping opportunity from here, pushing lower. Now, what do we have here? We have this order block, all right? One that we can also trust. But what do we have above the order block? We have an inducement. So we have fair value gap here, hidden order block. There is this hidden order block, which is around here. And then we have fair value gap above also. So that is an inducement. Now, what you could have taken is this for scalping, and then this one and this one as limits. And then, the stop loss is stop. Maybe this is the fair value gap. Let's see what we have. This is another fair value gap here. So maybe above here, the overlapping. Also, we have this overlapping. So we could lower it here at the other overlapping. That's your first entry. Second entry is at the inducement. Now, tell me, can you have a better entry with the inducement? Now, sometimes our only inducements are stronger than order blocks. And that's why I put inducements, number one, and then two order blocks. So if I have inducement, I'll take it first. I'll ignore the order block. If I have nothing but order blocks, I'll take the order block. In this case, I'll take this one. Now let's just imagine that we take them both and then maybe take profit here. Take a look at the precision here. Wick and then pushing lower. Let's look at the 1 hour time frame. Now, how can you convince anyone that you're going to be entering from here instead of L1 and then just pushing lower from there? Sniper entry. Now, I think these are enough examples. Let's cover the trading plan, or in other words, let's just summarize what we were saying, because the whole thing is a trading plan here. So this is going to be the focus for today, right? This is the thing. First of all, we want to start with high probability fair value gaps. And we have different videos covering these high probability fair value gaps. And then after marking these, we're going to be looking at the lower time frame. So lower time frame, higher time frame fair value gap, order blocks, and overlapping. And you're going to be marking all your zones. Inducement is the most important, and these are equally important. And then after that, now you're going to evaluate how much risk you can take, what types of risk you can take. You're going to be placing limit orders at the two extreme levels. So the two extreme levels, you're going to ignore all. And then the two extreme levels, you're going to place limit orders. And then what you can also do is scalping at the other level. So all of the levels that you have, the 4 hour for the fair value gap, and then for the internal analysis and to find the MAVG, you're going to be using the 5. And then if you want to scalp, you're going to look at the 1 minute time frame. All right. So this is the trading plan. Hopefully